Hey everyone, Market Mondays, Denny Troncoso here. I am actually doing this on Tuesday. We just had a storm that went by. We are fine, thank goodness. It was Hurricane Betty, went right by us. We felt it early in the morning, but no major damage in our area. Everybody's okay. Just had baby Lorenzo come into us at night, jump in our bed, and you know how that goes. But he's fine and everybody's fine. Last week, I had the opportunity to visit the Florida Association of Mortgage Professionals annual Florida conference. I actually enjoyed it. Have some good items to share from there. I won't be sharing them today because I'm going to do my normal market update videos, some review some articles, and then end with interest rates. And then just the last thing I'd like to share is we're actually getting some help. I've been doing these videos in English and Spanish, and just the upload times, it takes quite a bit of time. So now I'm actually getting some help with that, with doing some of the research, help with the social media. Hired a couple of freelancers to help there, and I'm excited about it. So Kevin and Emerson, thank you, and I look forward to just rocking and rolling with you guys. All right, so let's get to it, man. I'm gonna go ahead and share my screen. In fact, before I do that, let's talk about the market. I know yesterday we had a big drop in the stock market, 1,000 points in the Dow, and everybody's freaking out. I got some text messages from friends, and this is kind of like a Buffett thing. It says that he only looks at the market just to see what's happening in the morning and doesn't look at it after that, because if they said that there's anything else that's important that he needs to find out about, someone's going to tell him about it. And this is exactly what happened yesterday. I got a few messages from people about the market, and some of it's like, oh my God, the market, it's tough and this and that. And in reality, it's actually the best opportunity to buy if you're investing long term. And when I say long term, is 5 years or longer. So if you're doing that, go ahead and get in and buy, whether it's an index fund or if you buy some individual stocks. Make sure you know what you're buying there, do your research. But it's the best time to purchase when prices are low, when you're buying and you're going to hold long term. Today already, I mean, I saw the market go up the Dow like 450 points. So it just made up almost half of what it lost yesterday. And then so far this year, it's been on a tear. So it's just market fluctuations. It's part of life. Just get comfortable with it. Don't watch the market. You don't really need to look at it maybe quarterly to see what your statements are doing. Because if not, you can get sucked in by all that attention grabbing and, oh, the world's ending, but it's not. And I'm going to share an article on maybe one of the reasons why something could be happening with the market. Nobody really knows, but nevertheless, I'm going to go ahead and share an article here. So I think you should be able to see that. Let's see. Should be able to see my screen there. And this is yep, you should see that. All right, so this is an article from Axios by Hope King, and it's talking about the economy. It says why the Japanese yen is the currency strengthening is triggering a global market sell-off. One thing is that what's been happening is in the market that the Japanese economy hasn't been doing well since like early 1990s. So they've look to stimulate their economy with low interest rates and even negative interest rates. And according to this article, even investment companies have been borrowing at low rates and then investing it in the US stock market. And it has to be short-term lending, because what they're doing is they said that they're selling stocks to basically pay that money back, or that the higher the strength of the yen, when they then convert it, it's going to be affected. So they're trying to cash out here in the US, return the money back to Japan before they lose a lot of money in the currency exchange, or possibly in the debt, right? So whether this is the answer, I don't know, but it's a pretty convincing article. Check it out if that's something you're interested in. All right. The other thing I have here is the an article from the Federal Reserve. It's about the Federal Reserve. It's by Christopher Rugaber, and it says Fed sees cooler inflation, slower job market. It's by the Associated Press, as that's of August 5th. It says job gains have moderated and acknowledged that the unemployment rate has risen. The Fed is required by Congress to pursue stable prices and maximum employment, and the statement said the central bank is attentive to the risks to both goals. A major shift after several years of focusing exclusively on combating inflation. I've mentioned this in other videos. The goals of the Federal Reserve, these are the goals that they're set by Congress, are stable prices, and then full employment. Maximum employment is the term that they use. So they want to be able the economy, not everybody employed per se, but they have a term what is considered maximum employment, and it's around that 3 to 4% range. Really, it's maximum employment. But we've been on an inflation hike. Things have been going up over the last few years. It says the Federal Reserve said Wednesday that the greater progress has been made in reducing inflation to its 2% target, a sign that the central bank is moving closer toward cutting its interest rate for the first time in 4 years. So interest rates they've started increasing them around 2022, and they've been high since then, and really not really high because they went up to 21% in I think 1980 or 81, but they're at about 5%, which is and a point where the economy lending is not attractive, and for small businesses and borrowers. And they consider it an attractive point would be in the maybe 3 to 4% range, where the market rate would be in the 5% range instead of where it was. It's in the 6, 7, 8% range. So they're looking to reduce interest rates. The next point of the article says Fed policymakers also chose to keep the key rate at a 23-year high of 5.3%. That's what it is right now, 5.25 to 5.5. If inflation continued to cool, a rate cut could be on the table in September. And we're getting closer to the point at which it will be appropriate to reduce our policy rate, said Powell, the chairman of the Federal Reserve, but we're not quite at that point. So I wanted to get to the point with this article. This could also be the main reason of the fluctuations in the stock market, because traders, stock market investment companies thought that the market or the Federal Reserve was going to lower interest rates about 5 times or something like that this year, and they haven't even done one. They've done 0. So if that's the case, then they're actually with the lower the rates, the higher the stock market goes, right? Because lending, increases values, more money jumps into the stock market. It's like a whole Lollapalooza effect. So it's not happening. So that could also have been part of the reason the stock market just corrected, and it's swinging back and forth. So, I wouldn't pay attention to it again, especially if you're investing long term. Last Friday, the government said that yearly inflation fell to 2.5% in July, according to the Fed's preferred inflation measure. That is down from 2.6% the previous month and the lowest since February 2021. Unemployment rate has risen by nearly half a percentage point this year to a still low 4.1%, and hiring has slowed. That's what they said on Friday. But the expected job numbers of 175,000, but the actual job numbers were 114,000. So that means that the unemployment rate jumped up to 4.3%. At 4.3%, now people are scared that we're moving into a recession, and then, it's all connected. But what happens is, if the faster we move into areas of concern like recession, then the fastest interest rates go down, then the faster we get into an expansion. So again, markets work in cycles. A lot of information in this jam-packed article. Just wanted to say, don't worry about the market. Interest rates are getting ready to come down, and inflation is getting under control, right? So those are kind of the main things going on with this article. All right, so the next point, let's see. There's an article here. It said knowledge gaps may be thwarting buyers. And this is from Fannie Mae. Fannie Mae, if you don't know who they are, they're a quasi-government organization. So kind of the government controls them, but they don't. It's just created in the 1930s, right after the Depression, to buy government mortgages to help the mortgage market with liquidity. And they create a lot of the guidelines that a lot of lenders follow for lending. And the reason because they need to fit their guidelines, their box, to be able to sell loans to Fannie, and then they can do more loans, right? Because they do a loan, they sell it to Fannie, they do another loan. They make a little bit of money in between doing the loan. So there was 3,338 households. 92% say owning a home is important. rate. That's 9 out of 10 people find owning a home is important. 74% or 7 out of 10, they'd rather buy a home instead of rent the next time they move, right? So 7 out of 10. But 90% do not know what the minimum down payment is, and most of them are confused about underwriting criteria, debt to income ratios, and minimum credit scores. Here's a plug. I have a first-time home buyer course, free course, English and Spanish, on my channel. Wherever you're watching this, you can check this out. Check my profile. It's right there for you to get informed if that's your goal of buying a home. And then this is going to kind of give you the cliff notes, right? It's like a quick 1 hour, right to the point, learn how to do it, learn all the terms, learn all the basics. So when you talk to a lender like me, you're better prepared and you know how to get on the path, right? And then if not, contact me so we can work and get on the path together. All right, now shameless plug. 78%, so that's 8 out of 10, said that high mortgage rates say it's a bad time to buy a home. And 35% or 3 out of 10 say high home prices are a concern. Look, high home prices are going to become worse of a concern because when interest rates go down, prices are going to go up, guys. But then also high mortgage rates, if you can't buy an expensive house, maybe buy a house further out with the rates that are now, when later when houses go up, then you can possibly pay that loan down, sell that house a little bit. But now you're not renting and spending all this money on rent. You're actually owning, right? So earning, building wealth, building ownership, accumulating for yourself and for your family. The last few things are that most people didn't even know that there's a 3% down payment program with Fannie Mae and Freddie Mac, but something that they didn't talk about, that there's also a 0 down payment program with the USDA, right? If you're buying in a rural area. So there's a lot of programs out there. You don't have to remember all this. Just know that there are opportunities. If you want to get on the path, let's chat, let's talk, let's get on that path. It's possible. It just takes time. It's not going to happen overnight, but you can get on the path. All right. So jumping up to interest rates, guys. And now I'm going to go ahead and bring in my screen so you can see it here. Interest rates are conventional 30-year no prepayment penalty, 780 credit score, income is 10,000 a month, debt to income 24%, price of the home 400,000, loan amount 320, taxes. So they put down 80,000. You don't have to put 80,000, but just this example, allow to get the lowest rate possible. They put 80,000 down. Like I said, there's programs to put 0 down, 3% down if you're buying in a city. $4,000 taxes, $2,000 insurance, and then what's the rate? It's under 6%, 5.875%. Come on, guys. I think it's time. If we can find the home, I help you find a real estate agent too, because I won't find a home. But if I can help you get the financing so you can own that home, and I mean it's a super competitive rate. I mean rates in under 6. I mean we've been over 6, 7% for a year and a half, 2 years, even over 8%. APR 6.18%. Monthly mortgage payment includes taxes and insurance, $2,392.92. All right, this is if you're buying a home, conventional. Then we have SBA if you're buying a business. We got rates between 9 and 11.5%. Buying a business, recapitalizing business franchises, also existing business startups. And then last thing, if you're buying commercial real estate, building commercial real estate, 5 3/4, guys. I mean, rates were in the 6s, 7s. All right, so it's getting competitive. Rates have come down. I'm gonna go ahead and stop sharing my screen. And so if you like the channel, if you found the information valuable, click the subscribe button. Help us get more people to see the show. Go ahead and tell 10 friends about it, family. Say, hey, this is a great guy. He shares a lot of information about money, about buying homes, about investing. And that's, a lot of the information we're rolling out. Then like the show. Comment. Say, hey, Denny, I like that you shared this. I disagree with that. I agree with this. And I would love for you to cover this information. Can you cover this? Can you share this? I would love to work with you if you're looking to buy a home, invest in real estate. We check out my profile. We have tons of information there of all the things that we do. So until then, guys, see you with the next video. All right, take care. Bye-bye.